mutual fund to sahi hai, and mutual fund has been into existence for over 2.5 decades. A lot of good work is done by most of the large or even mid-sized asset management companies to be able to reach out to smallest of the smallest town in India. Hello everyone. My name is Vikas Agrawal, and I'm the founder of a company called AIF and PMS Experts India. Well, AIF is nothing but alternate investment fund, and PMS is your portfolio management services. So we are emerging as one of the largest platform for investing in alternate investments and portfolio management services. So when 4 years back, when I laid down the foundation of this organization, what was going on in my mind is how do we reach out to more number of investors, uh, share our knowledge, because we bring about almost 2 decades of experience on the table, and empower and educate the investor community as a whole. And I am grateful that thanks to our media partner ET Markets, particularly Rajiv sir, Shalini ma'am, for giving us an opportunity to have a sort of tie up with Economic Times and ET Markets, and helping us to organize this beautiful event. I'm grateful to all the investors, who have taken the time out from their busy schedule and decided to join our mission. Our mission is to educate as many people as we can, and the whole idea of educating and empowering investor communities so that they can create more and more wealth, they can enhance the overall performance of their portfolio, and they can go about creating a long-term wealth. So before we start the today's session, the topic that I chose to talk about is the importance of alternate investing in your HNI's portfolio, ultra HNI's portfolio, or some of the family offices who have been investing in alternate investment funds. Let me first, take this opportunity to thank all our partners who have supported. So our title partner is Axis Alternates. So Axis has been, has been putting a lot of efforts in terms of shaping up their alternate businesses. They are one of the pioneers. They have both alternate investments and portfolio management services, and they are one of the largest in the category. So they came out and agreed to join this mission along with us and helped us to reach out to investors like you. Then we have our platinum partners, which is Carnelian Asset Management Company. Then we have Vito Capital and Chanakya, which is also known as Stepbread. We also got a gold partnership with Bugle Rock, which is formerly known as O3 Securities, ASK Investment Managers, Prabhudas Leeladhar Asset Management, and Sundaram Alternates. Apart from that, we also got our association with Prudent Equity. Apart from that, we've got some silver partnership from company like Ampersand and Aditya Birla Capital. So तहे दिल से मैं इन सबका शुक्रिया अदा करना चाहता हूँ. Because of their support, we are today before you speaking and talking about the whole subject of alternate investments and portfolio management services in our conclave too. Last year, when we organized the conclave one, we got overwhelming support from most of the investors, and they really appreciated our efforts. So I take this opportunity to thank my entire team of AIF and PMS Experts India. This is last but not the least. Without their extraordinary efforts, we would have not able to reach out to investors like you. So once again, thank you so much, team AIF and PMS Experts India. So let's start the conversation. So I'm going to be your host for the whole day. We've lined up couple of sessions on alternate investment. We're going to deep dive what is happening in economy, whether this government is going to be stable, what are the fund managers' view on markets. We also want to talk about how these AIFs and PMSs would help you enhance your overall performance of your portfolio. So, in case you have any questions, you can type in your questions in the Q&A box, and we'll be taking up. Well, I'm not too sure how much time do we have in terms of taking those questions, but we'll put in efforts to do it. So I would request now to put up the presentation. So the topic that I chose to talk about is, we keep talking about mutual funds, keep talking about PMS and AIFs, and we always look out for some kind of comparison. I would say that mutual fund to sahi hai, and mutual fund has been into existence for over 2.5 decades, 27 years. I remember this was 1996 when mutual fund got regulated by SEBI, and post that a lot of good work is done by most of the large or even mid-sized asset management companies to be able to reach out to smallest of the smallest town in India. And as a result of that, we've got about more than 20,000 crores of money coming in, and in the form of SIP, systematic investment plan, and market has become more mature. I would request Manvi to please put up my presentation. Well, that is one. Mutual fund to sahi hai. It's an extraordinary job. But what we are witnessing is of late is that there has been huge value migration happening from some of the mutual fund investors moving towards alternate investments and portfolio management services. So we're going to deep dive on that. So let me just share my presentation, and then we'll have a Q&A if time permits. So one second. Can you see my screen? Is this visible to Manvi? Uh, yeah, one second. I'll just take a second. Sorry for the trouble. Okay, it's visible. Okay, so AIF and PMS Experts India, as I mentioned, that we are emerging as one of the largest platform for investing in alternate investments. But when I was conceptualizing this idea, I was thinking that how do we make it more sort of process driven? Because what I strongly believe that if you have right inputs, and if your quality of input is even more better, and if you have right processes, then the outcome is immense. And this has really worked in our life. So as you can see these gears, it's like when you switch on your drive the car and switch on your engine, you see all the other parts of the engine start supporting the main engine and work in a very symmetric fashion. Similarly, we wanted to kind of plug the whole gaps and see to it that how do we create the process-driven returns. Well, AIF is absolutely unconventional way of creating wealth. So, what are the conventional way of creating wealth? Is you go for fixed deposits. You can have corporate fixed deposits. You can lend money to some of the developers directly in the form of debenture, etc., etc. But this is absolutely unconventional. What we are witnessing is huge amount of innovations in terms of product developments, and we're going to talk about that in the next slide. So let's look at the diverse investment avenues. Well, you know that there are a few investors who have joined here for the first time may not be familiar with that. So let me just take a second to tell you about the minimum ticket size which is required for investment in alternate investment funds. For AIF, it is 1 crore as per the SEBI regulation, and for PMS portfolio management services, it is 50 lakhs. Apart from that, there are close to now 750 SEBI registered investment advisors who exist in India, and there the minimum ticket size is not defined, so you can start with as low as 5 lakhs rupees and participate in Indian capital markets. When exploring the AIF and PMS universe, so universe is very deep. When you look at AIF, so let's look at what is AIF. AIFs are pooled investment funds that focus on alternative invest asset class, whereas the PMS is basically a tailor-made investment portfolio comprising equity, fixed income instrument on individual securities. So basically, to make it more simple, AIFs are a pooled investment vehicles, whereas PMS is you're signing a power of attorney with the portfolio manager, giving them a mandate to manage portfolio on your behalf. However, all the stocks or the fixed income instruments which are part of the portfolio is going to be held on your name. So that's how the broadly this can be looked at. Well, these are different elite class. I already talked about mutual fund to sahi hai, but there are few comparison out here. Is that this particular, as I said, AIF piece, and I'll show you some data points, is shaping up very well. AIF offers an exhilarating off-road adventure, allowing you to explore uncharted terrain in the world of investments. It's thrill of navigating beyond the conventional way of investing. Whereas PMS is akin to having a luxury and personal chauffeur. It's like you decide which sector that you're bullish on or which theme that you're bullish on. Based on that, you allow the fund manager to tailor to construct your portfolio the way you want. And whatever is happening in the market, you don't have a direct impact on your portfolio when you invest in PMS, because all the shares or fixed income instruments are held on your name individually and has nothing to do with the world. So you do not get impacted by what somebody else is doing in the market. Whereas in mutual funds, because it is now has become a very retail investment product, you sometimes get affected by the behavior of other investors. For example, during the bad times when they decide to pull out the money, those investors who are remain there in the fund, existing investors, sometimes they get affected, because when you get the redemption as a fund manager, you have no option then to sell those securities. So it's like, to make it simplify, you have Ola or Uber app when you're using, let's say you need to go to say airport, and let's say it takes about 30 minutes time. So you have options of pooling the car, you have option of going in a luxury sedan car, or then you can also go for XUV. So all that option is available to you. So mutual fund is like a pool where every individual they want to pick up. So obviously it will take maybe 5 minutes more, but more or less everybody will reach the destination. Types of AIF and PMS. Well, before 2012, SEBI, people used to call it venture capitalist fund. Some used to call it private equity fund, and they used to say, a credit fund, etc., etc. But SEBI said nothing doing. From 2012 onwards, this got regulated. So broadly, it is categorized in three different parts. So you have category one, which essentially invest in startups, SMEs, social venture funds, which are well defined. The sector is well defined by SEBI. Whereas you have category two. In the category two, it essentially invests in private equity, private credit, real estate fund. Then you have category three. Now, category three invest in listed space. So, it's like a mutual fund. The way mutual fund invest in listed space. Similarly, this also invest in listed space. But these category three fund has an advantage of having exposure to unlisted companies also, and the limit is almost 45%. So up to 55% you can invest in listed space, and then 45% in unlisted space also. Then apart from that, you also have hedge funds, which is shaping up well in India. So in hedge fund, till about 2007, 2017, hedge fund did not had major presence in India. But thanks to some of the high quality portfolio managers decided to enter in Indian markets and start creating a hedge fund. Mukund, tell him to just close the window. So in the hedge funds, we see a lot of innovative players coming up, creating a long short strategy, which is something new to markets, where there are few investors who don't want to take risk of too much of volatility in the portfolio, and therefore they prefer to choose one of the hedge fund managers where they hedge your portfolio by say 30%, and they invest remaining 70% in long or short portfolio. So what do you mean by long is the stocks where they're bullish, they go long, and the short is wherever they are bearish, they sell those stocks. That's how it is. On the other side, you have PMSs. So PMSs broadly two categories, I would say, discretionary and non-discretionary. Well, discretionary, 95% of the assets are under discretionary portfolio. The discretionary is the discretion of the portfolio manager to decide what stock to buy, how much to buy, which sector to go long, which sector to go not to buy. On the other side, non-discretionary is basically meant for some of the large family offices where the treasury manager prefer to work closely with the fund manager, create the portfolio. But in case of non-discretionary, it is final decision is taken by the investor. This is a history of AIF and PMS. So as I said, this got regulated in 2011 and 12, and there is a saying that regulator is a father of the industry. And ever since it got regulated, AIF industry is shaping up big time in India. As we speak, the total asset under management for AIFs have reached to 7.5 lakh crores, and this is growing exponentially. Whereas when you look at PMSs, well, a lot of people don't know that it was first PMS which was started in 1993, and then mutual fund got regulated in 1996. So some of the broking companies were allowed by the regulator to run portfolio management services. But the whole thing got regulated, some started regulating from 2002 onwards. So the first PMS was launched by one of the largest asset management company in India in the year of 2000. And if I have to quantify in terms of number, that 1 crore invested by then in 2000 has become more than 55 crores as we speak. So this also has a very strong, consistent history. So, and this is only shaping up. And SEBI, of course, in 2012 and 2017, further introduced couple of regulations, which is as good as mutual funds. So now, broadly, SEBI is regulating AIFs, PMSs, and mutual funds, and almost all of them are at par, except for some amount of flexibilities are given to AIF and PMS managers in terms of buying individual securities up to 10%. For example, in AIF, you can buy 10% stock in a particular portfolio, and in PMS, you can go as high as 20-25% also. But in case of mutual funds, it is well diversified, keeping in mind that you have retail investors who have also put in all their hard-earned money and cannot afford to take too much of risk. Now, this is basically the history of AIF and PMS. So, as we speak, we have 1125 AIFs which are SEBI regulated. This 40 to 50% of them are run by some of the family offices who's managing their own money, and they found that managing money through AIF becomes even more structured for them. So you have three categories. We talked about that. It is meant for HNIs. On the other side, there are more than 250 PMS schemes which exist in India, and this the source is APME. APME is basically an association like MFI, which is started 2 years back. They are doing fantastic work in terms of uh, uh, getting this industry even more structured. So when we started this platform, what was going on in my mind is that there were few high quality portfolio managers, but they did not had an access to investor community, and broadly it was monopolized by some of the large wealth outfits in India. And on the other side, there were investors, like-minded investors, but they did not have the access to high quality portfolio managers. So we thought, why not we would build a platform where we bring everybody together and see to it that how do you take the maximum advantage of that. This is very interesting data point which has come to our notice, is that I looked at last 8 years of data points, because that's where, as I said, the AI got regulated in 2012, but the real innovation of the product and the introduction of some of the schemes started from 2015-16 onwards. That point of time, the total assets, the AIF had only 4.5% exposure to the total overall, regulated, the managed schemes of India, which includes mutual fund, PMS, and AIF. And as we speak, this is about 16.7%, which means that what was noticed is that this particular asset class is growing at 46% year on year. Whereas PMS is also shown good amount of growth, which is about 14%. And particularly in case of ultra HNI's portfolio, we saw a huge amount of growth, which is about 22%, to be very precise. Now, what are the advantages of AIF? The advantages are, first of all, it is well diversified. That's something very good. For example, I talked about category one, which essentially invests in startups. Then you have category two, where you have private credit funds. Now, of late, especially the new tax regime in which mutual fund investors who were investing in debt mutual funds, they do not have an advantage of the taxation anymore, and the indexation is removed from there. And therefore, what we are witnessing is huge value migration. Those investors are moving from mutual fund debt investment funds to private credit funds. Now, what is private credit fund? Is the fund where they would diversify their portfolio and lend money to those needy businesses, you know, who's got limited access to banking sector, because of the banking regulations, they are not able to get the funding, but they are scalable businesses. So these private credit fund essentially come in between the banks and the investors and lend money to them, diversify the portfolio, and deliver returns. The other thing is low correlation. For example, when you invest in private equity funds and you see some, a black swan event like COVID, when you see index going down suddenly by 30%, you don't see that kind of re-rating or de-rating in private companies. I mean, their valuation, for example, if you've invested in private equity fund and say Country Delight is part of your portfolio, you do not see that the major downgrade is happening there. So therefore, you have a correlationship, as far as index is concerned. It also generates higher returns, and I'll show you some data points how it generates higher returns. And risk is well managed by AI, because these AIF managers are well professional managers. In India, they're managing the risk very beautifully. It also reduces the volatility, and I'll show you some more data points there, how it reduces the volatility in your portfolio. And there are now, thanks to some of the AIFs which are open ended, so you can have a long longevity in the fund, longevity of your returns, unlike earlier days when you had only closed ended AIFs. So these days you have some of the good asset management companies coming up with open ended AIFs and giving you longevity of the returns. And then you can also have reliable income stream, in the sense that there are some old age investors and they want some amount of money to come to their bank account on a monthly basis. And I'm glad to share that some of the private credit funds or some of the real estate AIFs, category 2 particularly, are able to meet those requirements of our old age investors and keeping them happy. So that's something very good thing about our industry, that they are able to take care of their investors. And then we also talked about hedge against inflation. So we talked about hedge funds. We also talked about, there are instruments which are giving you maybe 8-9%, but it is well hedged against inflation. And also it reduces the drawdowns. Now let's look at where are these global investors allocating their funds. So this data I picked up, there was a survey which was done, and I picked up that data from there. So if you look at HNIs, and the definition of HNI is 1 billion, and for definition of ultra HNI is $30 million. So a huge difference between $1 million and $30 million. The listed, so the HNIs, they are investing their 49% money in listed companies. But when we looked at ultra HNIs, it is about 31%. Whereas in alternative investments, the HNI's exposure is 26%. But in case of ultra HNI, it has gone up to 50%. And they also prefer to keep some amount of cash in order to take the advantage of the black swan events. So that's how the AIF industry is. You have Americans, which is they have 79% exposure to alternate investment funds, and there are large firms, outfits in America, and they are focusing on alternate investment big times. We have also have a tie-up with a platform called Crystal AI, and when I looked at, there are 250 high quality portfolio managers, and some of their managers like Fundsmith, when you look at, or some of the other L1 fund managers, Their size is the total size of our industry as a whole. I was astonished to see that numbers. Then you have this is another area which is participating well of late, Middle East and Europe, particularly Middle East. What we are witnessing is we have clients in Oman, Dubai, and we are getting very good amount of response from these countries, and they are participating. So this is catching up. It's at 65% now, but it's catching up very fast. And then Asia Pacific is not behind by any standard. It has also gone up to 77%. So globally, 74% exposure is there. This is another very interesting slide, is that I talked about how ultra HNI behaves. And when we looked at some of the HNI's portfolio, and this is the data which has come from Bloomberg, and along with JP Morgan Asset Management Companies, they have done the complete survey on this, and this data is on 30th November 2022, and number has changed a lot. But this data is from 1989 to 2022. That even if you have 80% exposure to equities, your volatility is at 12.5, 13%, but your annualized returns is about 9.5%. But when you add up alternate investments up to 30% in your portfolio, and say reduce your equity from 80% to 50%, obviously your volatility goes down by good 25-30%. So it comes down to 9.5%, and your return also goes up. So returns are not going down, by the way; it goes up to 9.5%, or maybe at the same level. So you're reducing your volatility by 25-30%, but you're increasing the annualized returns. Very quickly, another interesting chart. This is done by one of the respected wealth management company called Client Associates, and along with Praxis Family Office report. So what this report says is that those investors, because they've been investing in alternate investments for over 7 years, whereas we started 4 years back, they looked at that in clients' portfolio. This is the sample model portfolio, which is there in front of you. There are investors to whom they allocated 20% exposure to alternatives, and that 20% yielded 30%. They contributed 30% post 7 years in the overall portfolio and yielded 30% returns. So if you add 20% money to alternatives and reduce your listed exposure from 50% to 35%, then one, your volatility goes down, and there are VC funds which has delivered 30% IRR to the portfolio in 7 years time. So that's the time when some of these early investors have made money. This is the journey of AIF industry. So Cat 3 particularly piece is shaping up very well. This is the data as on 2022, but as we speak, this has crossed more than 1 lakh crore. So more than 1 lakh crore of investors who have exposure to category 3 IFs. Some of the IFs are doing very well in India because of their advantage that they can participate in IPOs through QIBs, whereas the PMS have the limitation that they cannot participate in IPOs directly. So that's a technical difference. Because of that is going well. When you look at PMS, the total size of the industry has gone up to now 3 lakh crores almost. I remember when I started the journey in PMS 2007, I think, that when I started promoting PMS, and the total size of the industry used to be less than 10,000 crores. So clearly we see huge amount of growth. Well, now this is coming to our company. So, what I strongly believe as an individual is that if you keep on doing the same thing again and again, you tend to develop some amount of expertise in the long run. So like the way that you are looking at the picture, here is that this jar was broken by these people at least 1 crore time. And then they would reach to a level where they just touch the jar, and then, it gives you a very good shape. Similarly, we strongly believe that if you have right processes in place, and if you keep on doing the same thing again and again, you tend to develop your expertise. So as we speak, we have close to 300 investors who invested in our process because they trusted, basically. and we've got about now almost 500 crores. So we act like a chief investment officer for their of these families, because every small thing they discuss with us in terms of their financials, their what is the kind of goal that they want to attain in their life, and based on that, we keep discussing and suggesting them some unique ideas. So we've, as we said, we have investors from 10 different countries. We have, more particularly, we have many investors from Middle East, and we've got about 15,000 investors, because we strongly believe that data speaks louder than the words, and we are a research-driven organization. We prepare a list of all the high-quality AIFs and PMSs which exist in India, and keep comparing their performances, because performance ultimately matters the most. And therefore, there are 15,000 investors who come to our website aifpms.com and extract the various data points what is required. But in the whole thing, there are a lot of questions which comes to me particularly, and they keep asking that which scheme to choose, how to choose, etc. So what I thought is I'll just share a minute to tell you what we do at our end quickly, and then we'll conclude the session in next 10 minutes time. So we first of all formed an investment committee. It includes one of the fund manager of the industry also. The idea of adding up the fund manager is that fund manager will give us the complete 360 views, 360-degree views. May not be having a conflict of interest, and give us the independent views on how we are, what we are thinking is whether it is thinking in the right direction or not. And we have very rigorous selection process. We customize the portfolio, and we also make our clients prepared for black swan events. And we also tell them that, for example, right now the markets are going up. People are concerned that the historical P of the markets are in the tune of 20 ka P, and then it has moved to around 23, 24. Whether it is a time to book profits or stay invested. So of course we have an individual discussion on that. We also have something called consistency score that we generate based on various parameters like Sortino ratio, beta ratio, Sharpe ratio, and then information ratio. And based on that, we see to it that what investors do not like is the roller coaster. And what we are also against that is we want someone to be Q2, may not be Q1 all the time. But what we do not like is some fund managers behaving like going from Q1 to Q4, then coming up to Q1. So therefore we prefer to stick to somebody who is consistent in that. So that is the result of the process. If you follow the right process, your outcome is going to be same. This is the process-driven wealth creation formula that we have created for ourselves, which is called 3I's framework. And this is the in-house proprietary-based framework, because me and my elder brother started investing in AIFs and PMSs from 2013-14 onwards, and we have failed. We have failed 3 or 4 times measurably, and those learnings have really helped us to kind of come out with even more better frameworks. So this framework is that first thing that we look at is what is the style of the portfolio manager. One of the failures that I want to talk about is one point of time I felt that this particular style is the best style across the market cycles. Then 3 years down the line, we learned from our mistake that no, you have to have a multiple styles in your portfolio, in the sense that you have to allocate some money to growth investors, some money to value investors, value investing portfolio managers, some money to guard maybe growth at a reasonable price, or maybe you need at some point of time quantarian manager, in order to balance the portfolio. Then second thing is, because we are research driven organization, we thought we'll spend more time on understanding the quality of the portfolio. At no point of time we want to compromise with the quality. There are times when investors come to us and say that, look, this particular portfolio has delivered more than X percentage of returns. So we see to it that whether it has come through a proper process, quality, or it is a fluke, because that's very, very important. And third is the performance. We talked about consistency in the performance. This is a very important slide that we look at. We never compromise skill for luck. So we always see to it that we have to have right skills, and if you have right skills and right processes, obviously your outcome is going to be immense, and luck will start supporting you. That is the best position. Now I've given you already example that there are times when some portfolio delivers extraordinary returns because market has supported their portfolio at that point of time, and and very next year you see they are the most underperforming fund. And that is where the major accident takes place in our industry. And therefore, the tenure of the average tenure of the investor in the AIFs and PMSs is much lower than mutual funds. And we are the one who's putting a lot of efforts to see to it that we talk to investors, we understand their risk appetite, and then see to it that what fits into their portfolio. And then only the marriage takes place. So if you have to have a right approach, I would say that if you have best 3, 4, 5 best minds of India working in your portfolio, you are done. You don't need us also. So idea is that can we get identify those high quality portfolio managers and keep shuffling the portfolio. That's very important. So I already talked about skills to generate returns, define the process, and not luck always all the time, because you can be lucky once, but if you want to generate sustainable returns, you have to have right skills. Again, another example, when you have a strong process, you get the similar output all the time. So we believe in process-oriented portfolio. So we are very unbiased, and we create a customized portfolio. I've seen this ad of Raymond's that they customize everybody's jacket. Similarly, we also customize everybody's portfolio. These are some of the portfolio managers with whom we work closely. Some of the AIFs and PMSs that we like in the AIF and PMS space, and some of them have really done very well. I'm glad to share that our recommendation, the discussion and suggestion has gone up to, has created a good amount of wealth for our investors. These are the returns that you've already seen. We talked about it, that some of the good quality AIFs have ended up delivering 36% returns since inception. And these are really good numbers. On the PMS side, we have some PMSs which have delivered 43% CAGR in last 5 years. That is also remarkable achievement done by. So this is nothing but a testimonial to what I've been talking about. So with that, I'd like to conclude my session and once again thank all of you for giving me an opportunity to organize this event. And during the day, we want to deep dive the entire thought process of various fund managers, their investment philosophy, and see to it that how do you take the maximum advantage of that. So with that, I'll conclude my presentation, and I wish to thank all of you for giving me a patient hearing.